all suitably refreshed and ready for the second half of today's lunch. A huge thank you to all of our speakers before from the International Stock Exchange for their sponsor video and their welcome, to Jane to go through the report, and obviously to our panel hosted by Anthony Morrow. Thank you to them. I'm now going to hand over to Simone from EY, who will be hosting our second panel, and she will be joined by Jeremy, Jessica and Guy. So if I can hand over to you, please, Simone.
Thanks, Sam. Hi, I'm Jemery Masterson. I work at EY in the Transaction Services team based in Manchester. We work primarily across deals in the Northwest, focusing on technology and e-commerce sector. So this panel now is going to focus on supporting startup and scale-up businesses during the pandemic. So I'll hand over to the panel now to introduce themselves. Jeremy, would you like to go first?
Sure. Hello, everyone. Jeremy Cole. I'm the managing partner of the imaginatively titled Cole Associates Corporate Finance. We're based in Manchester, started in 2002, and we advise clients generally trying to do one of three things: either acquire a business, which would be a corporate acquisition or a management buyout, or grow a business, which would be raising growth capital, or selling a business. We operate in, I think, what's called the lower mid-market, which is businesses from startup through to around about 100 million turnover. We're sector agnostic. We work across pretty much every sector you could imagine, although I've always had a soft spot for high growth businesses and tech businesses, because I had 3 years working in PwC's Silicon Valley office in an earlier part of my career.
Great, thank you. So if we start now with just to hear your views really on how the various sectors have been affected during COVID-19, and maybe if we start with how has the early stage investments been affected in the past year, so the first time raises and seed rounds?
Shall I go first? I guess I would break it down to look at the supply side and the demand side. So from the supply side, going into the pandemic, a lot of the VC funds had raised additional funds fairly recently. So they were sitting on war chests. Also, there were lots of private investors and EIS funds looking for good investment opportunities. So unlike the 2008-2009 recession, there was a lot of funding out there going into this situation. I mean, on that supply side, obviously investors moved into a much more cautious mode. The VCs had some issues within their existing portfolios that they needed to address, so that occupied a lot of their attention. And private investors, particularly EIS investors, were very, very cautious in the second and the third quarters. Having said that, all the local VCs like Maven, YFM, Mercia remain very active and Procura, and the money was still there, albeit more cautiously. I think on the demand side, high growth businesses, startups, scale ups, a lot of them that we spoke to had a kind of presumption that it was not a good time to try and raise funding in even the fourth quarter last year, but certainly the second and third, and that was understandable. But my advice to a lot of them was at least start the process, open the dialogue with the investors, prepare to go to market, get your story right. Even though forecasting was massively difficult, at least open the dialogue and get yourself into the pipeline of the investors, because when better times come around, as they did do later in the year, the people who had already started those dialogues and had started the relationships were at least at the front of the queue. And I would continue to advise entrepreneurs and growth businesses to engage with the investors, even though you might have to allow for a longer period to actually get through to the investment in place.
Okay, and maybe just what do you think about the lack of events as well? What impact do you think that's had, not being able to go out and meet people like they usually would when they were trying to source funding?
I'd agree with that. I think investment is fundamentally a judgment about humans. making an assessment based on face-to-face communication. Obviously, Zoom, Teams, etc. has been great, but it's a poor substitute for face-to-face communication in all its various ways. I think also, whether it's networking or it's a one-on-one coffee between an entrepreneur and a VC or an investor, it's often not that first interaction that's important. It's the second or the third iteration of that. It's the referral to a friend or a friend of a friend, and another meeting. And to the extent that happens face to face, it's immeasurably better than virtually, in my view.
Thank you for that. And now just moving sort of outside of the Northwest, how do you think the Northwest has performed versus, nationally? I don't know if Jeremy, you want to lead on this one.
Sure. Yeah. Obviously, everybody's suffered to a greater or lesser extent. I think the Northwest has performed relatively well. I think the pandemic has been a bit of a leveller compared to the normal dominance of the Southeast. For example, rather than having to jump on a train for 2 hours to go and see a VC in London, it's relatively easy for a Northwest business to get some access to those VCs quicker through the virtual means. Also, we have our well-known success stories, Boohoo, AO, the Hut, etc. But down at our level, if you like, I think the Northwest has done relatively well. As I said before, supply and demand. We've got VCs, plenty of very active VCs in the Northwest, who are sitting on pots of money ready to invest. Northwest has always had that pioneering culture going back to the Industrial Revolution, and it's well known for its entrepreneurial spirit, the feeder universities, the talent coming out of the existing high-tech businesses and unis, the sort of infrastructure of advisors that exist in the Northwest. So all that's been a positive. Having said that, fundamentally, I think the lesson the last 12 months has taught us is it's all about sector, much more so than it used to be. And I think that will be the theme for at least the next 18 months, 2 years. It's going to be less about the quality of your management team, which always used to be the standout kind of judgment for a VC or an investor. And it's going to be primarily about sectors. And that's not just the sector that the business itself is in. I think these days you have to judge how robust, so I'm not going to use the resilience word, to judge how robust a business is these days, you have to kind of look through its customer base to the customers of the customers and to see how resilient or robust businesses are. And often they're surprisingly robust, and that applies to the Northwest and nationally. But generally, I think, yeah, it's been an awful 12 months for a lot of people, but I think the Northwest has fared better than most.
Thank you. And then how have you helped your investments or clients overcome burdens they face? So specifically, like, what extra help have you found they've needed over the last year, and sort of what areas have they needed that in?
I'd break it down into different phases within the last 12 months. So April, May time, I think for a lot of businesses, it was about going back to real fundamentals, about cash flow management. Is a customer who you build in February actually going to pay you? Having a long, hard look at your headcount, and really getting down to basics in terms of battening down the hatches. I think as the year moved on, we came out of the first lockdown, then a lot of businesses, again, it depends on sector, but for a lot of businesses, it was about moving from adapting and surviving to more, not so much thriving, but trying to make the most of the new world and to plot a route out of it. And again, from a funding point of view, a lot of funders in that period, kind of during the summer, say late summer, they were keen to try and do things, keen to invest, keen to lend, but they wanted data, positive sort of post-lockdown data to latch onto. So that was a slightly different phase to the sort of April, May phase. And then I think from kind of August onwards, in line with other advisors like us, we've seen just a surprisingly high level of engagement with investors, with companies being acquired, which is great. And again, doesn't apply to all sectors, but maybe there's kind of inherent optimism and positivity with investors, business owners, purchasers, and that's been great in the final quarter, and hopefully will continue into the new year.
Great, thanks for that, Jess. And I think just looking at time as well, I've got 2 minutes. So maybe if we just think about the future. So, you know, the market's still really buoyant in the first month, second month of 2021. Do we see this continuing into 2021 throughout the year?
I hope so. Yeah, I think if you go back to the fundamentals, there's lots of funding in the system, as it were. Lots of investment looking for a yield. So that's a positive. I think there are obviously some sectors where the last 12 months has accelerated changes that would have happened over the next 5 or 10 years. Everybody's familiar with those. There are other sectors like hospitality and travel and the creative industries, particularly the performing arts, where they've suffered horrendously, but once we're all vaccinated, then hopefully there'll be a massive bounce back and a resumption to something close to normality fairly soon. So no sectors that will be fundamentally damaged below the waterline. So yeah, obviously we're still in lockdown, so everything is still very difficult in terms of forecasting your business forward, but you'd have to hope we're through the worst of it, and the funding is there and the demand will surely come back as the rest of this year progresses, although I have been accused as being a hopeless optimist, but that's my perspective.